The growth is on a...
Uganda's 2025-2026 national budget, totaling Uganda shillings 72.3 trillion, seeks to strike a balance between fiscal discipline and economic growth. However, budget analysts offer a nuanced perspective on this financial plan. While certain sectors such as infrastructure and oil and gas are poised to benefit from increased funding, others, including the private sector, may encounter hurdles due to limited resources and potential underperformance.
From a risk perspective, obviously, oil and gas is much more complex. Taxation of oil and gas is much more complex. You're looking at the possibility of local entities being outcompeted by incoming foreign direct investors in the oil and gas sector. Obviously, if you don't have access to sufficient capital, then a much more financially able entity coming into Uganda to participate in the oil and gas sector will outbid you on the bulk of the opportunities.
Some experts note that despite the ambitious overall budget, the effectiveness hinges on how resources are allocated. Current allocations to sectors like agro-industrialization, tourism and mining appear underwhelming, especially given their importance as economic drivers.
What is our comparative advantage? Shouldn't we invest more in agro-industrialization, although we're in the digital age, but also considering our comparative and competitive advantage? We have to position ourselves accordingly, because while China is manufacturing electric vehicles, Tesla is also, out there. So are we going to compete with Tesla? Are we going to compete with China? I know we are playing catch up. We are late in terms of the digital industrialization, but also we should approach it based on our context, realities, aspirations, and also be able to put our resources where we will get value for money, because we have meager resources. We don't have too much to spend.
Another critical point raised by analysts concerns revenue mobilization. Of the Uganda shillings 72 trillion budget, approximately Uganda shillings 38 trillion is expected to come from domestic sources. However, a significant portion of this, nearly Uganda shillings 28 trillion, is allocated to debt servicing. This heavy debt burden limits fiscal space and diverts resources that could otherwise be invested in development.
Whereas we are talking about that, we are entrapped into a vicious cycle of debt. The debt servicing obligations will go up to 28 trillion. 28 trillion is a huge figure that we cannot take lightly. The debt servicing obligations are actually depriving us of the much needed resources to be invested in critical social sectors.
While the budget aims to be largely self-financed through domestic revenue and limited external borrowing, its success depends on effective implementation and prioritization.
So since there will be more money that will be put into oil and gas, so we shall see now companies in the private sector, and these are citizens of the country, so they have businesses. Since the oil and gas sector is coming up, so there will be so many opportunities, supply and chain contracts, engineering contracts, supply contracts, logistics, and because of this now we have more, we usually call them complementary services or ancillary services. So there are so many small other businesses that can come and tap into other sectors like accommodation, we have tourism, hospitality, ICT. So
David Ijo, NTV.